Steve Sachs, the 10-year is now yielding 2.7%. The yield moved up a little bit after Janet Yellen's testimony today. But in general, it hasn't moved very far off that 2.7% level. How can somebody make money in bond ETFs if that's the case?
Well, it ultimately, Greg, depends on what they think the longer-term picture is. Obviously, there's a lot of stuff going on in the credit markets right now. We had a 104 basis point backup in rates last year in the 10-year. We've had a little bit of move higher this year, but to your point, pretty steady the last few weeks. We ultimately think rates are going higher. So really, if your thesis is rates are going higher, you want to be lowering or taking your duration of your portfolio to zero if you still need to hold the bonds.
All in all, though, is this rising rate trade just too crowded among every single fund manager and hedge fund manager across not just the U.S. but the world?
I don't know if it's too crowded, but it's certainly getting talked about a lot. And right at the end of the day, is that a sign that it's too crowded? If you look at flows overall, though, we've seen a lot of flows into lower duration products. HYHG, the ProShares high yield interest rate hedge fund, has seen a lot of flows, up to 120 million in assets. But the fact of the matter is that we haven't seen a bond bear market in this country in almost 30 years, or actually a little over 30 years. The fact of the matter is it could take a while for this trade to get truly crowded. I don't think it's there yet.
So meanwhile, are you focusing more on credit risk as opposed to interest rate risk? Is that the play, is to worry about defaults as opposed to what happens with the Fed interest rates?
Well, I think interestingly enough, most investors right now, whether they be institutional investors or advisors or retail, they're actually worried about the interest rate risk. Credit risk has really died down. The fact of the matter is you've got US GDP growing at a fairly steady clip. You got global GDP growing at a fairly steady clip. The shock is over. It's really more about the interest rate risk than credit risk.
Steve Sachs, you're the best. Thanks for coming on.
Thanks, Greg.
Thank you for watching The Street.